This is Debbie, and I'm speaking with Michele Schneider. Michele, I was introduced to you because of a lot of great things. You've got a wonderful book out, you have a class, and you've been a trader. So maybe you can give us some insight today on exactly what are we looking at when it comes to today's market. You know, most people would think the interest rates are great, everything is rosy. Everything is not rosy. I think the rates are just low, and it's making our business and my business, the mortgage business, do well and real estate do well. But there's an underlying current I think we need to explain to people. Maybe you can give me some insight on that. What's really going on?
Well, we have to really step back to before the pandemic, because I think people have very short memories. The market and the economy was limping along even before that. We were always seeing money going into tech. And that's been strong because we're a tech-driven society. But tech is not the GDP, the gross domestic product. 70% of that really comes from retail. And then, of course, we look at supply and demand. So we look at things like the small cap stocks, which is the Russell 2000. And then we look at the whole transportation, which back in the day, Charles Dow thought, transportation index was equally important to the Dow Jones Industrial. None of those areas were doing well when NASDAQ and tech were making new highs in 2018, and then we had the crash. And then 2019, we saw some volatility. So as we started 2020, it was so artificially pumped up with the Fed lowering the rates, increasing the money supply. And then the pandemic hit, and you could see the market just swooned.
What a mess. Now talk to me a little bit about your background. You've been a trader on the floor, so you have a great, exciting perspective that we don't have. So how did you get into this business to start with?
Well, I was a special education teacher. Basically, I did exactly what I thought I was supposed to do. I grew up very low middle class, New York City. My parents weren't highly educated, and they did not have a lot of money. So we didn't sit around the table talking about our stock portfolio.
Okay.
So I knew nothing about business. And my parents said, oh, you're a smart girl, become a teacher. And I did. And I was really interested in kids who think differently, and particularly kids with special needs. So that's where I went. And then just sort of an auspicious moment happened. I was living in Manhattan at this time, and a girl knocked on my door who lived in my building, and she worked on the floor for Merrill Lynch. So she brought me down to the floor, and it was like, this is what I want. This is what I want. I mean, partly was because of the excitement, partly
Sure.
because there was very male dominated and I was young and single, and partly, well, yeah, let's be frank about it. And
there's
and
lots to choose from down there. They were just running everywhere. There you go.
I mean, the odd thing is that once I actually did get down there, I had to kind of balance. People say, well, what was it like to be a woman down there? And as far as the trading, as long as I was physically able to stand in the pit and compete, no one cared if I could have been a Martian. They didn't care. If I was adding liquidity, fine. If I was taking my knocks and taking my profits along with everybody else and not bitching and moaning and complaining, I was accepted fully.
Right.
The harder thing was navigating the social strata. I didn't want to be the party girl, but I didn't want to be the stick in the mud either. So that was the dance. But anyway, once I got down to the floor, I gave up teaching at that point, and my whole world changed. It was incredible. Commodities at that time was the 1980s. Inflation ran rampant in the beginning of...
It was a free-for-all back then. It really was.
Yes, I mean, a lot of the regulations that you have now didn't exist then.
Mm-hmm.
I mean, it was amazing. Front-running orders, seeing what they call high-frequency trading now is something that's been going on forever. So, you'd have these brokers that knew orders were coming in, and they would basically hit those stops and then take their profit. This is not a new situation. So I got to see it all. I got my finger on the pulse of the world. I traded gold, silver, sugar, coffee, and then went into crude oil, then went into the financial area. And then I went back out of the floor once it seemed like things were starting to get more electronic.
Right.
And my husband, who I met on the floor many, many years ago, he was already working on technology to make it easier for people to trade upstairs. So that was the end of my floor career, but it has shaped me as a human being on every level.
And so when you're talking about, you've got a new book out, so that makes sense because you're a teacher. You just want to pass down, like I do, some of the things that we've learned, because there's not a good money education right now. I don't think there ever has been. If you weren't brought up in a family that talked stocks, how would you ever learn about it?
Exactly. I mean, speaking of my husband, his uncle was a stock trader. And so by the time he was 12, 13 years old, he was trading. But most of
Wow.
us, even those of us who go on to business school, you don't really learn about speculating the markets. You learn about the stock market, you learn about, price earnings ratios and GDP and all of the economic terms. But as far as having a real strategy to invest, that is something that behooves you to take on yourself.
And we don't know how to do that. I mean, I deal with people in the mortgage business, and you would think that if you had a high net worth, you would be well versed in buying stocks and investing, and people aren't. They just happen into it if they're good at it, or if they put their money in a 401k and they let it ride forever. Tell me
Right.
what we can tell me what we can look at when we're looking at our investments now. There's a lot of people that want to sit on the sideline with cash because they don't know what's going to happen with the election or the pandemic. So is now a good time to be in, or should we be out, or what should we be doing with our money?
Well, it's always good. I mean, you hear the term a lot, diversify your assets, and people don't know what the heck that means. But there's normal safety plays, of course, may not always be so safe. So you really have to look at your portfolio and your 401s. Obviously, what people don't realize is that it's good to take profits when you're deep in the money and reduce your exposure. And it's also good to have a bottom line stop in your mind of where I'm out, that's it. I want to stop the bleed, and then I'll stand aside. So that's one thing. In terms of diversifying, there's a couple of trends that have emerged this year from the pandemic. One being the fact that the dollar has really lost a lot of value, and China has some role in that and could continue to have a
Sure.
role. That could be really disastrous for us on many levels. So you have to watch the dollar. And then the bonds, which people usually run to for safety, haven't really done very much. So gold, silver have been the places where people are going to hedge in case the election creates even more chaos that we already have in this country. If we have a second wave of the pandemic, I wouldn't necessarily say that's good for gold and silver because we could see a liquidity crunch. So I think the bottom line is that it really will serve everyone to be aware of where their money is, potentially get out, especially with this little run we've had in this week after selling off last week. If it doesn't hold, which already I can see as we're talking is starting to wane, that rally.
Sure.
Go to cash is perfectly okay, except the fact that you don't get anything for your cash.
I was going to say you just lose money when it's in cash with inflation, but it's better than writing it down. So, I talked last week on an interview that I did that, a lot of times people stay in the market too long because of greed or because of pride. Those are two great big things that really wreak havoc on all of us. Is if we think we pick that stock, we're going to write it down, we know better, it's going to turn, and you just hang on too long because you're not happy, like you said, taking money off the table. You want to make more. And does greed play a factor in that?
Well, the three emotions that are so huge in trading is hope, fear, and greed. Right? So, and also it's interesting, as human beings, we are actually more programmed to fail than to succeed. When things are going well for us, we're all like, oh my God, how long is it going to last? I can't believe it. I'm actually making money. And some people will actually get out of a stock that they bought too soon because they can't believe they're making money.
Okay.
But even if they don't get out, then that's where the fear and the greed comes in. And then the hope again that things will turn around because we're so used to failing. That's what our DNA shows. So if the market starts to go against us, we're like, oh, I'm taking a hit. I'm taking a hit. I'm taking a hit. I'm taking a hit. Oh,
We're used to that.
Yeah, we're used to that. And we figure, it'll turn around. Oh, it's only money. All the rationalizations come into our heads.
Sure.
But that's dangerous and is very easily avoided if you just get a modicum of education about what you're doing, what you can afford to lose, and how to manage that account. And if your account is being handled by somebody else, I would hold their feet to the fire to understand what their plan is.
Right. So a lot of people have financial planners and they don't understand their background and what their limits are. My limits and what I can take and risk may be different than somebody else's, may be different than yours. So when you say there has to be a stop point, that's something that you establish in your mind before you even get there, because you know what you're in, you know when your out is, and then you know how high you're going to ride it, you know how low it's going to go until you're going to get out.
And what's interesting about the pandemic is that it's brought a lot of speculators into the market because they were home with nothing else to do.
Yeah.
So they started to trade the market, which is great because it adds liquidity, but also very dangerous for them because they haven't learned anything about investing, and they caught a rally from March, really basically until last week, that seemed, you can't lose. Market always goes up.
It
So
doesn't always go up.
no, it
Right.
doesn't. And actually our debt right now has exceeded our GDP, which
So what
is
does that
only,
mean?
okay, so what that means is that we actually owe more money than we are actually creating in growth for our economy.
And most people would say, does it really matter? Because I have more money going out than I have coming in. And you and I both know how dangerous that is. People get used to that as a comfort level.
Well, what's dangerous about it right now is we have a China factor in here, in that they've already started to say that they're going to buy less of our bonds, and they're the second largest holder of US bonds. So we need China to buy our debt. Believe it or not, we are the largest holder of our own debt, and taxpayers are responsible for that. So all of this, people use the word bubble, but what does the bubble really mean? It means that if we follow suit, and one of the countries that basically are in the same situation, or were, and are still trying to get out of it, where their debt exceeded their economy, was Japan. And so Japan is a great model because in 1980s, late 80s, they peaked. And here we are now, all these years later, 40 years later, and Japan still hasn't gotten to where it was back in the late 80s. Could that happen here? Well, we've already taken out all the tools. You know, the Fed is printing money, the money supply keeps surging. Not only is China threatening to reduce their bond buying, but they're also threatening to reduce their exposure to the US dollar. With money supply growing and the dollar going down, we can get into an inflation, but even worse than an inflation, a stagflation, and that's where the economy stagnates, excuse me, but inflation of raw material prices start to go up, which is,
and we're seeing lumber go up right now. We're seeing a lot of the commodities that we need go up, and that's going to change our system for next year, isn't it?
Well, yeah, because what happened with the pandemic was, even though everything got hit initially, a lot of, especially the food commodities, really, because of supply chain disruption and lack of production and lack of labor force,
Yeah, of course.
Went from an overproduction and an over amount of supply to now being somewhat in danger. And what's the one thing that everybody needs? Food. So
toilet paper. I was going for toilet paper.
And toilet paper,
food,
yes.
Food, yes, yeah.
Right, but you need the food before you need the toilet paper.
Yeah, exactly. So. But yeah, I mean, there's a lot of things we figured out we needed. So if some people say, I want to invest, Michelle, and be something safe, it would be, was it the Procter and Gamble's? Is it the Pepsi, the Cokes, the Starbucks, the food that we like? Is that where we go?
Well, you're looking at companies that are food related. And so they may do well, but it could also have the reverse impact, because if their food prices go up, then they have to raise their prices, which, by the way, has already happened,
Sure.
Which makes it more expensive for consumers. And then they say, do I really need that latte at Starbucks? You know, I can go back to Folgers. It's cheaper.
Right. I can make it at home. I don't have to eat out. Yeah.
Exactly. I mean, you know, obviously everybody's going to need their toothpaste, et cetera, et cetera. But it doesn't necessarily mean, when we say inflation, that it's going to hit the company's bottom line, but the actual raw material. And this is what I traded. I traded the actual commodities, the things that come from the ground. Those are the prices that have already gone up. Soybeans, corn looks like it's about to explode. Wheat has been stabilizing. Coffee has gone up. As you mentioned, lumber, yes, in large part because the housing boom continues in the more rural areas, in the more, rural areas.
Yeah.
As people are fleeing the cities because of COVID. So all of this is what I'm watching. I wouldn't necessarily say that's the safe play, but I definitely think that's where the money's going to be in the next 6 to 8 to 10 months.
Okay. So we're going to invest in, if we're going to invest in commodities, it's going to be those that we just talked about. If we're going to invest in companies and stocks, it's going to be then in companies that use those things.
Maybe or maybe not. Because
Okay.
remember, if their raw material prices go up, then that could hurt their bottom line.
Got
And
it.
you know, a lot of these corporations were allowed to buy back their own stock, and right now there's been a freeze on that through the pandemic. So I would be overall cautious in most equities. What I would probably be looking at would be some of the value, which has been really beaten up. Here's another interesting thing to be aware of. There's growth stocks, you know, like your tech, Google, et cetera. And then you have the value stocks, stocks that Buffett is known to have grown very wealthy on. Well, he certainly did not have a great year this year because the value stocks have gotten killed. And that difference between value and growth is at a historical difference. And it's only been there twice before, 1928 and 2000. Which we had, obviously, everyone knows what happened after 28, and after 2000, we had the dot-com bubble. And we sort of had that tech run, which almost was looking like another tech bubble happening. So it's not a guarantee, of course, but, and I certainly don't want people to listen to this and go, oh my God, doom and gloom. Because, you know, you just never know, really, the pandemic, the virus could
we have a whole new normal now. And how long is this going to last? How long are, I do a lot of Zoom, you know, I was on a Zoom call last night with investor clients, and they were in their house in San Antonio, and I was here in my office, and I thought, okay, this never would have happened before. They want to sit down at a table and see you face to face. We're doing business totally different. So I'm getting to see more people now. I'm not traveling near as much, and I'm helping them just the same. I mean, you and I can be friends over Zoom like this, just like we can be in person, but it's different. It's going to stay different for a while, don't you think?
I think so. I think, well, so much is going to depend on what happens with the weather getting colder and whether or not we see some kind of a big second wave. I am so sorry about that phone. I thought
that's okay. It's just business.
Okay. Boris is taking care of it for me. Yeah. So basically, if the second wave comes like the way the Spanish flu happened, you know, we're really in for some deep, hard times. But if for some reason, I wouldn't really put my hopes on a vaccine, although everybody and their brother is trying to get one. We could see with AstraZeneca that vaccines are not so easy. They can actually cause harm.
Right.
So if the second wave comes, forget it. But if it doesn't, then I think what's going to happen is you have already people who are COVID deniers, in that they don't think that there is a virus that we should be concerned about. You know, the flu kills people, et cetera, et cetera. Those people are already sort of out socializing. We have a bunch of people that have one sort of foot in socializing and one foot out, kind of keep the distance with the masks and maybe not going inside restaurants, et cetera, not flying.
Right.
If we don't get the second wave, those people will hit. They'll go immediately, and that will be a boom to the economy. And then those people who are much more skeptical, who really want to wait and see, will give it a few months, and they say, nobody's getting sick now, I can jump in. So, you know, we're on a big if. This is an if the second wave doesn't happen. And if it doesn't, I think things will go back relatively.
Kind of normal?
Kind of normal. As I said, I think you'll have tiers. You'll have the people who don't think it exists already out there, the people who are on the fence joining them, and then the people behind them will say, oh, okay, maybe it's time for me to book that travel or go on a cruise or whatever they haven't been doing.
I think a lot of people feel like it's just not safe to be out, or they shouldn't go out to have any fun. This should be a no fun time. Everyone's sick, no one can have fun. And so, you know, you've got different, like you said, different levels. Tell us about the book that you've written. Show me the book again.
Okay.
Put that up there.
Okay, it's called Plant Your Money Tree, A Guide to Growing Your Wealth. And what I did was I took my special education background. One of the things I didn't mention is I actually went back into education after I left the floor for a while before I joined Market Gauge. And I became a consultant this time on modifying curriculum for kids with special needs to be able to go into the general education environment.
Wow, okay.
So I would take a biology class. My specialty was the upper grades, when it really is hard to include kids with significant disabilities. So I would take a biology curriculum. and I would condense it down to just a few points, so whatever that child's capabilities were, they could at least participate with their typical peers. So that was a training I had, and I did very, very well with that. And then when I went back to the markets and been trading all these years and have all these strategies, I have a service that people follow me where I teach them and they follow my trades, etc. Then it became obvious to me, like you said, that so many people don't know anything or even afraid to look at their statements. How could I put my special ed background and my trading background together? And that's where this book was born. So it really follows these 6 phases. It's like a compass or a navigation system, very simple graphs we all learn in grade school. It's not intimidating. And it's also not condescending because it assumes that you want to have a little bit of knowledge. And even if your takeaway is to be aware of the fact that there are these phases, then you know more than you know now. And yet from there, you can also really learn a lot and start to understand all the instruments that your portfolio is in, and say, call your broker or your financial planner and say, hey, wait a minute, how come I'm in oil? It's in a bearish phase. Why do you have me there?
Right.
You know, when
most
are we
people
getting
don't even know. You know, when I talk to them on a mortgage loan application, I go, what's in your 401k? They're like, I have no idea. We haven't looked at that statement in months.
Right, exactly.
How
like
can you not?
Put it in the book.
Yeah, you just, and I remember in 2008, before the big disaster, there was a time when I was filing my 401ks and I didn't look at them. That's because they had dropped so much. But now we need to be educated. I mean, with the internet and so much out there, oh my gosh, there's no reason why we don't have an education. So how can we find your book? How do we find you?
Well, if you go to my website, it's www.marketgauge. It's actually written right behind me here.
Okay.
The banner comes up is the book, and it has a bonus, a free bonus, where I have a video where I explain the phases. So that's one way to get it. Of course, Amazon, Target, Walmart, they all carry it as well.
Isn't that exciting to be a published author like that?
Oh, it is. And it went to actually bestseller status in retirement planning categories on Amazon. So it's exciting.
That is huge.
Oh, I'm trying now to work on a second book. We can talk about that another time. But,
good.
But the other thing I want to say is, if you want to communicate with me, I'm devoted to teaching. I am a natural teacher. I can't help myself.
Right.
So,
sounds like it.
Yeah. So I think that if you want to actually even have contact with me directly, Twitter is a really good way to go. Okay. And my handle is @MarketMinute. So if you follow me and you have a question, I answer everybody. I make a point of doing that. Everybody is important to me because I know how scary it is right now. So this is my way of giving back, is really being able to share my knowledge and care about people and their money and try to do whatever I can to give them whatever I have during this time.
And that's just so nice because, you know, a lot of people in the money world are kind of slick and slimy, kind of get in, get out. You know, there's wheeling and dealing going on. Now that really rubs people the wrong way. And I think a lot of people stay away from investing because they think it's all kind of slimy. And it doesn't have to be. This is educated decisions. Now, how do we follow you if we want your advice on stocks?
Well, I would say that you can go on the website. There's a live chat, which doesn't go to me, but our customer service person, Mary, can always send me a question. Okay. Twitter would be another way to talk to me. And you can also email me. My email is mish@marketgauge.com. I'm all over social media, so I'm pretty, if you want to find me, you can find me.
Excellent. Well, what should we be thinking about when we're looking at our portfolios going forward through the election? I think a lot of people are nervous. The pandemic has made them nervous. And the first of next year, everybody just can't wait to get to 2021. What do we need to be thinking about when we're looking at our portfolios now?
I think you've got to look at NASDAQ first and foremost right now, because that was the leader. And it had a big hard sell-off last week, bounced, and now is selling off again. So I think if it breaks down under 2,700 or 270 would be the cues, I think you really should start thinking more defensively about what you want to do, how much you want to sit out. Because you already had to sit out through 150% correction, and then it came roaring back. We just had a 15% correction. Do you really want to sit through another 10 to 20 to even 50% correction?
And I guess a lot of that depends on how old you are. Like, when do you need this money? So I'm 56. I don't plan on retiring for another 20 years. I have kids in college still. You know, they
Right,
cost
right,
me a fortune. So
right.
I'm not going to leave anytime soon, but I can write it out. But do I have to? I mean, it's not
No,
something I have to close my eyes and grit it and just bear with it, right?
you know, you can look at your 401s, you can talk to your planners and say, listen, I want to liquidate, especially things that you're underwater in. And I want to kind of stand pat and maybe have, you know, more of a cash position if the market looks like it's going to fail again, which right now I'm
It kind of
noticing.
looks that way, doesn't it?
It does kind of, if you don't mind, I'll take a little peek here.
Sure. Give me
It's
that
all,
expert advice.
well, right now the Qs are trading right in the middle from the high last week to the low the other day, Tuesday, when
Okay.
we all came back from Labor Day week. So if it holds around this 280, 281 level, that's a good sign. But as I said, if it starts to falter, and I know people
270
are,
is what you were
yeah,
saying.
and people are saying, well, why should I be looking every day? You know, I've been doing this for years. Because we're in a different time. The volatility has really picked up. And that's
Interest
another,
rates change every day, and people say, well, when do we lock? And I'm like, not today. You know, we can try again tomorrow. And they say, well, doesn't it just change once a day? No, not right now. It goes up and down. I can have 3 different sets of rates on any given day. Easy.
Exactly. Well, Debbie, I hate to do this, but I do have to go. I have to actually
Good.
teach my subscribers in about 3 minutes. They're
Tell
on
me,
a
how did
block.
we get to that? How we get to that subscribers?
Well, if you go again back to the website and you look at our products, if you look at Mish's Market Minute Advantage, MMMA, that's my service that these people pay for. And every Thursday, I do a live coaching. So they come join in my room. They can see me trading live. They can follow me. They can ask questions. And I do another video on Tuesdays. They get an email alert every night with picks. They get scanners. And I also tell them, buy this. They get a text alert. This is where your sell stop is. This is where your profit target is. So I manage it with them through these active alerts. So it's a really good
Perfect.
way to have your hand held and learn at the same time.
Got it. Thank you so much for your time today. We'll talk again.
It was such a pleasure to meet you, Debbie. Thank you so much for having me.
Thank you.
Okay, bye.